Hey everyone, Doug here again. And if you're retired or getting close, this is not the year to coast into the holidays. With brand new 2025 tax rules, income limits, higher standard deduction, rising healthcare costs, and the financial decisions you make before December 31st, they matter more than ever. So today, I'm breaking down the top 5 year-end moves every retiree must make to protect your tax bill, preserve your benefits, and set yourself up for a stronger 2026. So let's dive in. Move number 1, protect your senior deduction by managing your income. Move number 1 is all about protecting your income-based deductions, especially the new senior deduction for taxpayers 65 and older. This deduction is very valuable, but it phases out fast if your income goes even a little too high. So before December 31st, take a close look at your income. Will your RMD push you over the limit? Are IRA withdrawals stacking on top of Social Security? Did you sell investments this year? Are dividends, interest, and distributions going to bump you too high? This is a year and the next several where managing your taxable income is a strategy, not a chore. And if you stay under these limits, you can save thousands. If you cross them, even by a little bit, you can lose benefits. So we need to be intentional. And I'm just going to say this right here. It's late in the year, so you may not be able to fix it this year. But we need to be very tactical for next year on this one because, like I said, we may have already missed that. But if we're invested in things that are creating taxable income or maybe not even taxable income, the way some of these adjusted gross incomes are calculated, we need to prepare and plan to take advantage of these deductions while we can. If this is something you need help with or you feel like you're not currently getting the advice you need, go ahead and let us know. Down below, I'll have a link to our office, and you can go ahead and set up an appointment. All right, move number 2, required minimum distributions. And trust me, the timing matters more than people realize. If this is your first year taking RMDs, you turn 73, you can wait until April 1st of next year. But doing that forces you to take 2 RMDs in the same year. And this can be a major trap. Yeah, you can wait till next year. But what can happen is it can push you into a higher tax bracket because now we got 2 in 1 year. It could cause us to lose deductions. It could trigger nasty IRMA. It could increase our Social Security taxation, and it could blow up our income plan for 26. For most retirees, the smarter move is to take your first RMD before the end of the year. And if you don't need the income, a qualified charitable distribution, a QCD, is a fantastic strategy. It satisfies the RMD, but doesn't increase your taxable income, helping you to stay under those critical thresholds. And if you don't know what a QCD is, it's a qualified charitable deduction, and it essentially means you take money from your IRA and you give it straight to a charity. It can satisfy the RMD, but not create taxable income, and that can be huge, especially under the current rules. Move number 3, take a fresh look at your portfolio. After the massive market run we've seen over the past few years, most retirees could be much more aggressive than they ever intended. Some sectors have soared, stocks have jumped, and what used to be a balanced portfolio might now be overweight in equities. A year-end rebalance helps. It can help us reduce risk, it can help us lock in those gains, and it can tune your portfolio to your retirement needs. It can also help us manage taxes more effectively, prepare for 2026 volatility, and if you're in a low tax bracket, consider harvesting gains now, not just losses. Everybody is currently talking about tax loss harvesting. Well, sometimes it might make sense to tax harvest gains before you're in. And if you have any underperformers, harvesting losses can offset those gains and reduce your taxable income. This is about smoothing your ride in retirement, not necessarily chasing the highest return. Move number 4 is what I call your year-end income control trio, because these 3 steps work together to protect your tax brackets, deductions, and Medicare premiums for 26. So first, we need to make sure we fix our withholding before December 31st. Retirees can often under-withhold or over-withhold on Social Security or pensions and end up with surprise tax bills in April. And with the new income limits under the 2025 rules, that could be even bigger. So check your withholding now. If you need to change it, use your W-4V for Social Security or update your pension withholding election. Adjust IRA withholding if needed. A 5-minute update today can eliminate a 4-figure tax bill next spring. The other thing is, if we get it wrong the other way, then the IRS is getting to sit on your money interest-free all year, and we're not getting the benefit. Next, you need to map out which accounts you'll withdraw from next year. We've got our traditional IRA, our Roth IRA, our taxable accounts, maybe a strategic blend, maybe you have some life insurance, but we need a smart withdrawal sequence so we can reduce our total taxes over our lifetime, lower future RMDs, keep Social Security from being taxed more, or maybe even at all, and help us to stay under these senior deduction limits. Not to mention avoid IRMA surcharges. And those of you who have it know what IRMA is, and if you haven't had it, you don't want to find out. So this is one of the most powerful financial planning tools we can do, and year end is when you lock in your strategy for next year. Once again, if you're not doing this or you're not getting this help, let us know and maybe we can help. Now, while we're on this vein, maybe, I don't know how else to say it, maybe a mini Roth conversion still makes sense. Maybe we're doing big Roth conversions, but if we've got some room in our tax brackets, maybe a small Roth conversion makes sense this year. Not a big one, just a small one, as long as it doesn't hurt our deductions and our IRMA limits. And it could help us fill up those lower tax brackets and reduce future RMDs and increase tax-free income later. But the window to do this closes December 31st. So we got to make this decision now with intention. Now, I know some of us that are moving a lot more, it's not going to matter. We're not going to worry about these little deductions, the $12,000. If I'm trying to move $400,000 over the next couple of years, maybe I just need to get it done. So once again, let's be careful with this, but the time is running out. And move number 5, your charitable giving strategy, because the tax benefits change next year. In 2026, non-itemizers get a new charitable deduction, and that's great. Now, if you're 70 and a half or older, QCDs can be the star of the show. We've talked about these before. They can reduce our IRA balance. They can satisfy RMDs, like I said a minute ago, keep our income low, protect our deductions, and prevent higher Medicare premiums. Giving feels good, but giving strategically feels even better. And I want to talk about this just a little more here because there can be confusion on this. So let's say we need to take $15,000 out for our RMD. We don't really need it, and we normally give money to our church anyway. Well, if we take the money out the regular way as an IRA distribution, that becomes taxable income, and then we're donating that money to the church. But if we don't have enough to itemize, we got no benefit for it. Plus, it pushed up our adjusted gross income, which could affect our IRMA, it could affect the senior deduction, etc. It could affect whether we're eligible for the $40,000 SALT tax deduction. But if we give it directly from the IRA to the charity, that's called a QCD, it satisfies our RMD requirement, but it doesn't go on our income. And that can be very, very important when we're trying to manage these tax brackets. So there you have it. Top 5 year-end moves every retiree should make before December 31st. We need to manage our income. We need to handle our RMDs correctly. We need to rebalance our investments, control income for next year, and be smart with our charitable giving. These moves can dramatically improve your retirement outcome, lower your taxes, and if you need help building this strategy, book a call. That's exactly what we do, and make sure you subscribe for more tax-smart strategies just like this. Now, next